First of all, sort of investing in, sort of local communities is really a very, very important thing because of, sort of what it means in terms of the livelihood of the individuals that are living in those places. Now, we're going to be focusing on public-private partnership, and we're going to be looking at a very specific program, and that's called the Emergency Capital Investment Program, and that's a U.S. Department of Treasury program. It was a Recovery Act program that is really unique because of the fact that it was, imagine, we all know how hard fundraising is. And imagine if, sort of somebody just magically said, here's all the capital you need to really have substantial impact. That never happens, but it actually did happen, sort of as through one of the Recovery Act programs, which is ECIP. So what we're going to do here is we're going to talk about that program in terms of what some of its early results are and, sort of what the impacts are on the institutions and what that may mean in terms of, future models for investment. Now, sort of what I'd like is if we could have each of our panelists sort of just introduce themselves and their background. We'll start with Saurabh.
Thank you. Thank you, Janine, and thank you to SOCAP for the invitation for this important panel. My name is Saurabh Narayan. I'm president and CEO of a nonprofit community development financial institution, CDFI. We invest in CDFI banks and minority banks, and we invest in low-income communities nationally. We've been in the business for 30 years and in banking for 40 years. I don't know how that works, but thank you.
Yeah, thank you. I'm Peyton Batliner. I'm the Chief Lending Officer at Native American Bank. We're headquartered in Denver, Colorado, but we got our start up in Montana on the Blackfeet Reservation back in about 2001. We just opened a branch up on the Tulalip Reservation, just north of Seattle, about an hour. So we're expanding, and a lot of that is thanks to ECIP and other, public-private partnerships that we've leveraged in the past to grow the bank. So happy to talk about that more. Thank you.
Do I have to press anything?
No, I think
just speak. Hey, everyone. My name is Mike Fredericangeli. I'm the CFO over at Beneficial State Bank. We're a certified B Corp CDFI based out of Oakland. We were founded by Tom Steyer and Kat Taylor to change the banking industry. My CEO was supposed to be here, but he flaked as of Friday, so unfortunately you're stuck with me. I'll try my best. Usually I'm more behind the scenes. He's the face of the company, but excited to share some of the great things that we've been doing with ECIP so far and what we want to do in the future.
All right, very good. Now, just to level set, because I'm sure, some people in the room know what the ECIP program is, but many others probably don't. So just by way of background, in 2020, and this was in the midst of, sort of the kind of the COVID, sort of crises and, some of the economic fallout and then sort of some of the kind of social unrest that was happening at the same time. Congress and the Trump administration worked together to basically create really an unprecedented, which was about a $12 billion package. And this was really intended to be, I'll say, anti-recession, but it was more than that. It was really focused on trying to provide long-term investments into CDFIs, which are community development financial institutions, for those that don't know. And these are basically financial institutions. They can be banks, they can be credit unions, they can be loan funds, they can be venture capital funds that are focused on serving low and moderate income communities, and at least 60% of their activities has to be focused on that. Now, the ECIP program was focused on the banks and the credit unions, which are, the depository, the regulated entities. And so, this was, the act provided, it was $12 billion total, $3 billion went to the CDFI fund, through some of the programs over there, but $9 billion went to ECIP. And ECIP was really intended as kind of long-term growth capital for depository, CDFI banks and credit unions. And I'm wondering if Kathy Mann is here. Is she here? Is she in the, oh, there she is. Perfect timing. Kathy, CDBA, my organization, was one of the leaders in terms of getting this enacted by Congress. And Kathy was one of my partners in crime in terms of getting it done. And she's from Inclusive, which is the trade association for the CDFI credit unions. So Thank you, Kathy, for perfect entrance. So anyways, what ECIP was really intended to do was to help these institutions do even more and really scale up the level of activities they were providing in the low-income communities with a real intent on trying to unlock access to capital for some of the hardest to serve places, or let's say, the smallest of businesses or nonprofit organizations or others that make a real impact but have a hard time in terms of accessing capital. So, really the value of this capital to mission-focused institutions cannot be, sort of overstated, and it's been very successful to date. Now, most of the institutions got their money in 2022, so we're still early in the trajectory, and our two bankers are going to tell us a little bit about what this has enabled them to do already. But just a couple of stats, and this is from the summer of 2022 when most got their money, through December 2023, the ECIP participants reported total originations of $58.3 billion. And, it was divided amongst different kinds of activities, but, the vast majority of them, were what they call qualified or deep impact activities, which are some of the hardest to do activities. So I guess with that, what I'd like to do is I'd like our bankers, we're going to start with them in terms of questions. So first, sort of, and maybe I'll start with Mike and then we'll go to Peyton, how has the ECIP investment opened new opportunities for your bank, and how has it changed the way your bank approaches its work?
Yeah, great question. So I sort of step back and look at it from our mission. Our mission is to help more people and help people more. So if you think about and I don't know if there's a lot of bankers in here or if they're non-bankers, and apologies, I just got this on Friday, so I may have to read off this a bit. But capital in its simplest form is one of the two critical inputs you need to grow a bank, the other being liquidity, which is essentially deposits. So we're a $2 billion bank today, but in theory, with the additional capital that we received, we could be a $5 billion bank. Based on sort of allowable capital ratios. So we're not trying to grow for growth's sake, we're trying to grow because of impact. But if you just think of it and do sort of simple math and say, well, if there are $2 billion today, $1.3 billion of that is loans, you can grow to $5 billion, now all of a sudden our loan book might be able to grow to $3 billion, right? And so now, as long as the loans that we're making are of equal or greater impact than the loans in existence, then we've just made a much bigger impact. So I can give some examples of the programs that we've done. Maybe Peyton can just kind of share what his bank has done, and then I can go back to some of those examples.
Yeah, and I'll follow your framework there. Well, when we received ECIP funding, about $37 million, back in 2022, we're about a $200 million bank, so an order of magnitude smaller, right? But I mean, it's been transformative. We're now a $400 million bank. We're capitalized to the point where we can grow to $800 million kind of organically. So that is a huge impact for what we do out in the Native community. And I think we'll talk about specific projects that we're funding, but it really allowed us to punch above our weight, right, in building community facilities, critical infrastructure, financing projects, getting partners that would never play with us involved, and that's that expertise piece, right? Capital's important. You need to have the minds behind it to actually be willing to work on these projects. So we have some really innovative projects that we've done with these dollars that brought people together and built just critical infrastructure that communities need.
And in terms of the capital, I know Janine kind of mentioned the background on it, but not only did they actually all of you, it actually came from US taxpayers, so thank you very much. Not only did they give unbelievably favorable terms, essentially the dividend rate we're paying on this capital is 2%, so the biggest and best banks in the world couldn't even get close to getting that. So it's much appreciated by the banks that did receive it, because otherwise they generally have a much harder time raising capital, and if they do, it's at a much higher rate. So again, that just affords us a better ability to deliver on those projects. And to the extent we deliver on the lending that Janine had mentioned, I mean, we as a CDFI and Native American Bank as a CDFI and MDI sort of by definition are going to be doing that lending within those communities, but this just allowed us to enhance it, and to the extent we do more and more, we're effectively able to get that dividend rate down even further, which again is just more capital for us, which means more reinvestment there. We have a bunch of different verticals within our bank. Some we're looking to expand further, and I can talk about a partnership in a second. But one of our core portfolios that we have is in the auto lending space. We had actually acquired a bank about 7 or 8 years ago in the California Central Valley. And so our focus there is twofold. There's some really nefarious lenders out there in terms of how they approach auto lending. And so we've tried to change what we do there with our partners and how we treat our customers. But another program that we've been able to grow more significantly is what we call our auto refinance program. So I can give you some sort of real world examples there. That's most of our originations today. So you may have a customer that maybe they didn't have the best credit a year ago, took out an auto loan, and it might have been in the high teens, maybe mid-teens, and as they've improved their credit, and we also have services that actually help people improve their credit or at least give financial counseling, we can go out there and redo their loan at something like 8%, right? So that's a 5% differential, and if you kind of equate that, math to, let's say on average the loan size is about $30,000. That's $100 a month. That's meaningful for the types of communities we're investing in. So that's one of the big programs we've been able to, while we're already doing it, now we can go double what we were going to do before. Again, that's that greater impact. The other thing that we have a huge focus in is in the affordable lending space or affordable housing space. As you know, the cost of housing keeps going up across the country. It's really, really tough for people at the lower wage scale to be able to afford stuff. We as an organization, actually, just kind of an aside, have a program where we're paying our sort of a lowest experienced people above market because we believe in more of that equity. But nonetheless, not all firms do that, and it's tough for people to afford housing. So in as much as we can support that affordable housing space, and it was not only the ECIP that allowed us to do it, but as a CDFI, at least prior to this administration, we were eligible for significant grants that were great in that we were able to redeploy those grants to other nonprofit developers in the affordable housing space, such that they may get a reduction off their interest rate, or maybe there's a closing cost credit that went back. And by doing so, they, in some cases, went from not being able to financially afford a project to being able to financially afford it. So in some cases, it's a question of, like, can we actually build that affordable housing or not? So that's been a great program where the ECIP's given us the capital, but then that's been coupled with some of the CDFI programs. Unfortunately, that's, if you follow that, that's not in the greatest shape right now with this administration, but I know there is bipartisan support for it, and so I'm hoping that that'll rebound because regardless of sort of the color of your state, like the Congress people have acknowledged that this makes a huge difference. It's like almost reinvested for, I think I've heard it, Janine, what's it, 8 to 1, 10 to 1 back in the community with that. But those are two examples for us. We also have a focus on climate-related lending. I would say that's not as seasoned as our other portfolios, so we're looking to see how we can deliver more on those fronts.
Do you want to give some examples,
Yeah.
Peyton, of what you've been able to do with the money?
Absolutely. So kind of structurally, what do banks need? We need capital to raise our legal lending limit so that we can finance bigger projects, and loan loss reserves so if things go wrong, right? So ECIP fundamentally did that for us and allowed us to play in a space where we could go after projects that were supported by other public programs like new market tax credits, if you've heard of those. Structurally, it's a pain if you're not 10 million and above in deal size for those types of projects. So when we applied for ECIP, it was healthcare and housing that we were primarily targeting, and we funded a number of healthcare related deals that are 20 million and above for us, which is amazing, right? One specific deal which our chief credit officer 2 years ago won an award from NAFOA, the Native American Finance Officers Convention, for the deal of the year, which was with Le Coudray, or LCO. It was a $44 million healthcare deal. We bundled new market tax credits. NAB provided, Native American Bank provided $20 million of source loans into the new market tax credits structure. And then we also paired that with a USDA guarantee. So, I mean, we used all of these, and we brought in 5 CDFIs, 4 native and 1 non-native. So talk about just putting all the pieces together to solve a critical problem, which was healthcare, in an underserved area, right? So, and we've done that with Pawnee, we've done that with Pitt River, we've built housing with Dry Creek, Rancheria, and we also rebuilt the Denver Habitat for Humanity headquarters with these dollars. So, we do a lot with a little, right? So
very good. What I'm wondering, both Peyton and Mike, how has this program and the receipt of this money, how has it changed just sort of the way your bank approaches its work? From how you're looking at the future and so forth.
Yeah, I mean, we talked about the scale. I think one of the other things for us that I think is worth mentioning is how can we scale more effectively? So with this capital, we're actually able to redo our entire technology stack. We had one that didn't quite meet the needs of the strategies we were trying to go towards. So we did spend the better part of 2024, instead of focusing on growth, converting our entire technology stack. That's going to enable us to do more, deliver more across the spectrum of consumer customers, larger commercial customers, and it's already starting to pay dividends in that, because we've talked about sort of the lending that we do, which makes a difference in the communities, but even the deposit taking, even though we're the ones that are taking in money, when you're providing the right financial education, when you're providing the right services and advice for the small businesses to be able to effectively manage cash and run their business, that's part of the whole sort of banking ecosystem. And that's one of the ways that's enabled us to do that. Fortunately, we have a really thoughtful board. For us, they've sort of reaffirmed our strategy this past July of you've got the new technology, you've got some critical hires, no more excuses, go get that into the community. So we're really pushing to do that. I will say, one of the challenges that we would have as well as them is at the end of the day, we're still a bank. We're a heavily regulated industry. We have to run our bank in a safe and sound manner. So as much as I can sit there and say, we could in theory go from $2 billion to $5 billion, if we went from $2 billion to $5 billion in short order, we'd have our regulators knocking down our door, because we have a fiduciary duty to our depositors in the FDIC fund, right? You're covered sort of $250,000 or less, but we have a lot of large depositors, big nonprofits, big for-profit, that those deposits aren't insured. So if we're not running our bank in a safe and sound manner and something would happen, then they're going to lose their money. So obviously that's first and foremost. How do we approach it from also a risk management appetite, so that that comes into play in all the decisions that we make as an organization.
Yeah, and we're also updating our tech stack, which is a process. Yeah. So yeah, absolutely. It kind of frees you up to think about, what do our customers need, borrowers need, depositors need, treasury management, what services do we need to provide for large relationships, right? Where we didn't really think about that before because we were too small. So now we can have those relationships going forward. And tribes are getting to be very sophisticated organizations with complicated business processes. They need banking partners that can facilitate, their needs and what they, their growth plans, right? Which, Native American Bank at $200 million can't do that for a large, casino, gaming, hospitality, right? Tourism tribe. So, we want to get there eventually. So it's allowed us to think about that. How do we grow to make sure we're not only meeting those critical infrastructure needs for tribes and their members, but also how do we bank tribes as, entities, right? So that's absolutely critical. And then the last thing I'll say is patient capital. It's allowed us to be patient as we develop these deals. These new market deals, they can take almost 2 years to put together, put all the pieces together. And tribes are governments, and they come with the same administrative complexity that any other government comes with. So patient capital is extremely important. To have that there is critical when we're structuring these projects at the beginning.
Let me ask one more question. We're going to go to Saurabh. You've talked about a lot of the opportunities and how it's changing your institutions, but what have been the challenges you've had? This is like, Magic Fairy gives you a big bunch of capital, and capital has always been the thing that holds everybody back. So now you get the capital. but what are some of the challenges? Because you guys got these resources at a time when the economy was not behaving, sort of in a way that was particularly made it easy. So wondering if you can speak to that. Whoever wants to go first.
Yeah, human capital, right?
Yeah, human capital is
we
one.
had to expand what we did and how we did it, and learn how to finance and structure these more complicated deals. Working with third parties and consultants, right? These new market tax credit, you get on a closing call and there's 20 lawyers on there, right, from all different entities. So I mean, we had to grow that capacity internally to be able to do that. We wanted to lead so that we could bring in deposits, which was a key part of this, that you have to bring in deposits to facilitate that growth as well. And we did that by bringing in the construction deposits, right, and leading those projects on the construction management deposit side, and drawdowns. So that was kind of a unique way that we kind of managed that. But as those run off, as these projects get built out, those deposits run off our balance sheet. So we need other partners to come in and begin banking with us as well. So that's what we're looking at now. Yeah.
Mike.
Yeah, and I think the key word for me is that it's patient capital, which is phenomenal. My CEO likes to say it's all carrot and no stick. We could literally go out and stop doing our lending, not that we would because that's not who we are, but there's no penalty in doing so. So it really enabled us to be patient and get that infrastructure built because we didn't want to build it on a foundation of sticks. So I talked to you about the technology piece that we did that enabled us. We had made some critical hires, a chief operating officer, making sure that we had that foundation in place before we started layering on. This way, as we grow, we knew it was sound and secure. Just from what Peyton said, the other critical piece for us is deposits, building that liquidity. So the way a bank works is it's essentially for every dollar of capital, you can have $10 worth of assets or loans, but you need the other 9 to be filled out with deposits or other funding, but you really want it to be deposits, otherwise you run into some risk issues. So anyways, it's given us the chance to be patient, get through the things that we needed to get to, but now for us, we're trying to step on the gas a little bit and really, get this money into the communities that we have. We don't have that same new market challenge that Peyton mentioned, but we as an organization and who we stand for as a mission, I think about 60% of our customers or 60% of our deposit balances are from non-for-profit entities. And so they're facing their own challenges right now. So while we do a great job retaining our customers and keeping them and continue to grow them because of the challenges that they're facing, while they're still staying a customer of ours, we're seeing some of their deposits start to run, their cash as our deposits start to run off because some of the grants and other sources of funding is starting to dry up. So now we're thinking sort of strategically, how do we continue to deliver for those organizations, but really expand who else we can bank that's still part of our mission universe and grow that way.
All right. We're going to go to Saurabh and get his perspective from the impact investor, sort of what this means. But before I do that, I wanted to note that we are going to be doing a Q&A. And you have somebody somebody's going to be passing out, I guess, pieces of paper. So if you want to write down your questions, and they'll bring them up here to us. So Saurabh, sort of from the perspective of you've worked with banks for a long time, sort of you have an investment portfolio that includes a series of different mission-focused banks, and you've also done deals yourself on this. The ECIP program has provided a really great opportunity for, the CDFI banks and credit unions to grow and to scale and to do more. But they've also, some of the big challenges have been raising deposits, raising new investments. And so while they have this new investment capital that helps them, the only way they can turn it into impact is by finding deposits. So, and that's been really elusive. Many of them have their organic deposit bases in their communities, but they need so much more in order to really totally, sort of put all of this new capital. So, what should CDFI banks be doing differently? Or what, sort of should they do that they haven't been doing to attract depositors?
Thank you, Janine. Firstly, let's do the numbers again. $9 billion, as was it Mike or Peyton who mentioned, 10x is the leverage, so it becomes $90 billion. Times 60% is the certification requirement, is $54 billion. Times, let's call it the turnover of 3 years, so that's whatever it is, $162 billion. That's the amount of new capital that can be invested in low-income communities for impact. The banks are open for business, and they're looking for high-impact, projects that can deliver the impact that they're seeking. And I'll come back to the deposit question because that's related. To be able to get to that $162 billion that I just talked about, we need to raise those deposits. And those deposits either come through construction-related deposits, they come in through normal nonprofit customers, or through you and I. This is a room of impact investors. We need to make sure that every cent of our deposit goes into CDFI minority banks. And that will only help them grow and grow scale for creating the impact that we are all seeking. So then, the question becomes, what is the rate and what is the term of these deposits? And I often say that a deposit is not useful to the institution if it is not one of these three things, if not all three. It's long-term. So if you give me 3 months deposits, it's okay, but it's not okay. If you give us 5-year deposits, then Mike's going to love you and Peyton's going to love you. It's got to be lower rate. And it's sometimes got to be uninsured, but that's a different kettle of fish that different people can think about. So what banks need to do is to demonstrate that this money is being put to good use. And both Beneficial and Native American Bank have done a tremendous job of talking about where the money is going to be put to use, so the impact. Now, the impact is an elusive question. We all talk about impact. Impact is different for different people. Somebody wants job creation, somebody wants housing, somebody wants, affordable housing. Yeah. So different kinds of measures of impact are there. Now, what banks need to do, and are doing a very good job of just now, some of the work that you're doing, some of the work that we are doing, is to sort of segment our customers to meet their impact needs. So if somebody wants job creation in San Jose, California, well, we can create a bucket which sort of meets that need, or Oakland in California, or in Alaska. You just opened a branch in Alaska, yes. So we need to be able to segment the impact creation. As well as, I think in a certain sense, we need to be close to market. We've got a pretty low cost of funds, low cost of capital. So we can be pretty competitive, in terms of the rate that we offer. So we have a surplus deposit that we place with our banks, and we are able to get a pretty good interest rate from our institutions. So I think the banks need to sort of step up. This is a moment of strength where we can take on a very large position with these institutions, but we can open up, behave a lot more in a market-friendly manner as well.
All right, well, let me ask you another question to follow up, sort of to what you have said. Now, sort of we have this program and, sort of it started in 2022. Treasury, the U.S. Treasury Department, which is the owner of these securities, they have a 10-year hold. So, sort of we're still sort of young in the program. We've already had some pretty impressive results. Just to give you a sense of scale, there were 93 banks that were selected to participate in the ECIP program and about 83 credit unions that were selected. So how do you think this program sort of will impact how investors see this group of institutions in the future, and what will they want to see from the performance of these institutions, so that when we get to the end of that 10 years, sort of there'll be even more interest, sort of in this group of social enterprises, I will call them.
So we're an impact investor in a CDFI. Our portfolio has about 15, 16 banks. We know another 100 banks around the country. We've done some work in our past life in credit union world. About $1 billion of the $9 billion sits in our banks, in our portfolio. We are really excited by this thing. We're excited not only from the impact perspective, I talked about the impact aspect of it, but also from the valuation perspective. If you think about it, if you get, again, I'll do the math on it and do it quickly, 2% capital times 10, so that's the cost of capital is 0.2%. If you're earning a margin of 3% just now, that margin has suddenly gone up to 5%, 4.5%, 5%. So as an investor, I am very excited because all our institutions will get valued at much higher multiples than they have ever been in the past. This is the single largest gift, and in the context of the title of this panel, it's the single largest, I call it a gift, partnership between the public sector and the private sector for the purpose of creating impact. And I think these guys are doing a fantastic job in that. So.
All right, very good. Now, getting to one of the points that Mike, sort of alluded to earlier in his remarks, the economic fallout is what created, sort of the atmosphere that this program was. The economic fallout from COVID, as well as some of the other, I'll say social unrest, sort of, after the death of George Floyd, as well as just concerns about, stabilizing the economy, is what led to the creation of it. And this was, at that time, it was the Congress and it was the Trump administration. So now here we are, fast forward a number of years later, we have a new Trump administration. And despite the partnership that there was during the first administration to create this program, the last 9 months have marked a really dramatic change, sort of in terms of the, sort of the position of the administration towards, sort of this industry. So how has the changes in the political environment sort of affected your institutions, and how do you think CDFIs should pivot in the current environment? And that second one's for you too, Saurabh. So, Mike, do you want to go ahead?
Yeah. I mean, I go back to our vision: help more people and help people more. That's sacrosanct to us. We're not going to abandon that, but it doesn't mean there won't be changes in terms of how we approach things, right? So I mentioned affordable housing lending. I mentioned some partnership with CDFI that enabled us to do some loans that maybe we otherwise couldn't do. So we're still going to make loans, but now maybe we have to do it a little bit more on market terms because we don't have that subsidy to help it out. So we're looking at alternative sources of grant-type funding to help facilitate that, but we're also saying, we as an organization need to stand up without that and maybe deliver it in different ways. So Rob talked about sort of low-cost deposits. That's been, sort of a bread and butter for us. And again, unlike maybe, your traditional community banks, we're not just trying to drop that to the bottom line. We do want to show that as a bank, we can be profitable like other community banks, not for the sake of just making money, but again, I go back to why our founders found this bank in the first place, was just to show that a bank can do good and still be profitable. And if that holds, then you may see other banks start to emulate it in terms of the practices that are out there for us. So it has created challenges for us when we're trying to figure out the best way to battle through it. But as long as we keep our North Star around a mission, there may be some changes to it, but we're still driving towards that in sort of every decision that we make.
Peyton.
Yeah. For those that don't know, a couple weeks ago, the CDFI fund employees, those are the federal staff that run the CDFI fund, received a letter saying that they might be RIFed by December 16th.
Meaning terminated.
Yeah, reduction in force. So public-private partnership, if we don't have the public component to partner with, right, there's not that private development and that private capital that Mike alluded to, which is a 1 to 8 right? $1 of CDFI fund dollars managed by those critical staff, right, comes out into our communities. There's 64 native CDFIs. How many other CDFIs are there? 14?
Oh, there's 1,400.
Yeah, 1,400-ish. 1 to 8, right? So $8 of private capital flows into that model. That goes away if you don't have staff on the other side to actually assist us in running these critical programs.
Yeah.
So, yeah.
Yeah, and the ironic thing about this is that the CDFI still have really strong bipartisan
Yes,
support.
absolutely.
Even though the Trump administration proposed zeroing out the programs in the new year, the House Republicans actually put the money right back in again.
Right.
Now, the Senate hasn't acted yet, but, sort of, this is just sort of showing some of the chaos that we're dealing with right now, where the administration is saying we don't like this, the Congress saying we do like this, and not just the Congress, but it includes the Republicans too. So.
Right. Yeah, absolutely. I mean, wide bipartisan, support for that. Along with, administrative turmoil is the government shutdown, right? We're right now waiting to close on 4 deals, $26 million, right? They're just sitting there. We have approvals in hand. We just need the staff on the other side, right, so that we can close.
Yep.
So literally sitting on our hands, sitting on capital.
We have another one like that that's slated to close in December, a big affordable housing deal that, from what I'm hearing now, because of it, it may actually push till next year. So, every delay you have is 1 less month or 2 less months of, someone being able to be in a home. So it is real and tangible for people.
So good. Sarah, your thoughts?
On how we should behave differently?
Well, not necessarily how we should behave differently, but sort of just in terms of kind of the pivot. How do we manage this environment?
Well, before I go there, I want to say thank you to Janine and Kathy for the ECIP program. I mean, I think these guys were the architects of putting that program together. There's a lot of money that's come in, and I really appreciate that. So, thank you. It's under-recognized, and that's why I said it's important to sort of say it. So, as an impact investor, firstly, I will just continue to sort of talk about the business model a little bit more. I often call myself a tough love kind of a guy. We need to evolve our business models such that we do a lot more things as big guys and gals. Larger loans, larger deposits, larger sort of, factor. And I think whether it's the Republicans or the Democrats, they all want success in their local markets. And, Mike and Peyton are right. Without some of the CDFI fund subsidies, some of the harder to do deals will not be possible. But this is a moment in time where we have received really low cost capital, and we can invest for long-term growth. So we need to step up and demonstrate to the politicians who are, who, as Janine rightly pointed out, who provide bipartisan support to the sector and strengthen their arms. And strengthen the arms such that they will continue to provide long-term this thing. So as examples, if there is a tough deal where there's affordable housing or a nonprofit facility and it requires some subsidy, can we step up, either take a higher level of risk? Can we find other philanthropic partners? Can we find other local city and state government money to make those deals happen and demonstrate that these institutions can get to the next level of scale? These are very difficult times, but this is a moment in time where we can evolve.
All right, I think we're going to open it up for questions. Does anybody have a little a card with a question on it they wanted to bring forth, or if you just want to stand up and ask your question, that's fine. Yes, Steve.
How overall are these loans performing, the program itself, in terms of people paying them back, or is it high rates of default? Seems like that would be a strong argument if they're performing well to keep the program going. What's the, I'll change my question.
Yeah, it's a great question, and one I get asked a lot. What is it like lending to tribal communities? when we're lending to a tribal government or tribal program, the default rate is 0. They're not going to let their healthcare facility go bunk, right? Their tribal administrative complex. That's generally what we see. So extremely low default rates. Tribes can set their own codes, they're monopolies, they're sovereign entities. When we're lending to a tribal utility, they're a monopoly that can set their own rates, right? So I think it's kind of a good thing and a bad thing that banks don't know, how stable lending to tribes is that I don't have to compete as much with them, right? The other ones that don't want to learn about this. So yeah, it's been pretty amazing. Yeah.
I can tell you that in our portfolio, the non-performing loan rates, the loss rates are minimal, consistent with what Peyton just said, minimal, and outperform the peers in the market. This is a very strong story. It's a story of CDFI banks, minority banks, credit unions, operating in the toughest markets and having the best quality of assets. And it's the world of investor community who don't think beyond the next 15 minutes in that sense will often say, oh, working in low-income communities is very risky. No. There's experience sitting here of the last 30 years, even as a CDFI, which demonstrates it's not as risky. The difference between perceived and actual risk is very small.
All right, very good. The other question we got is, what is your recommendation on how to access ECIP loans? We're a nonprofit providing affordable housing for disadvantaged populations like those who are formerly unhoused or incarcerated. Our bankers. How do you find out how
Talk to me after this, please. I'll connect you with our lending team. So in all seriousness, we do affordable housing up and down the West Coast. We're in Oregon, Washington, and California. But I think for something even like that, we would consider, going outside of our footprint. So I don't know who had the question, but please come see me and I'll exchange information and we can and connect you with our credit team and see if that's a viable project that we could support within our credit box.
Yeah, and we have a nationwide footprint, and we don't just bank natives, right, in tribal communities, right? We'll bank anybody. We can't redline against, non-native communities, just like, other banks can't redline native communities. So we often bring in whatever local CDFI is in the area or regional CDFI. We refer to CDFIs. If, the deal's not good for us, go talk to them. They might be able to work with you on that deal, bring it. Sometimes there's a little TA that's needed at the front end of deals that we as a bank can't necessarily provide. So we'll refer to those partners as well.
Okay. Now there are about 1,400 CDFIs across the country. Not all of them are ECIP participants. Like I said, 93 banks, 83 credit unions approximately that are participating in the program. But I think probably CDFIs across the country, if you've got a good deal, if you've got an affordable housing project, you should go talk to them. So sorry, you were going to say something.
I was just going to say, this is a national convening, global convening, but at least from a national perspective, you'll probably find a CDFI anywhere in the country. So talk to one, and it's very easy to access the names on the fund's website. But also, the important thing to keep in mind is with ECIP, we have the ability to take on larger positions. What, Peyton described earlier was a $40 million transaction. $40 million transaction, which wouldn't have happened otherwise. And most developers would say, these CDFIs are small guys. No, they're not. They can do a lot more today.
Okay. Something for Mike and Peyton. How do you find the loans to do? Because often at conferences like this, some of the sessions I've sat in for the last 2 days, I sometimes hear from nonprofits and for-profits. They're like, I just can't find anybody interested in doing the kind of deal I'm doing. How do you find the customers that, become your borrowers, and, what would you recommend for somebody who's looking for capital right now?
Yeah, we have a great sales team that's embedded in the community, so they're attending events like this, other ones, getting their name out to know that, we do these types of mission lending, and it's just building those partnerships organically. So that's how we source a lot of our stuff, but I would say we're even going further now with ECIP. We talked about some of the scale of our other businesses, like in auto, but another example is, we're about to partner with another non-bank CDFI who originates mortgage loans for sale. So we're going to start getting a program where we're purchasing those. It helps us from an ECIP standpoint. It also allows them, because they're selling that and they sort of churn mortgage loans, they originate and sell, that all other things equal, they can start doing more mortgage loans. So if they have an outlet for those types of loans with a bank like us or some other bank, then they can continue to do more of it. So, that's one of the ways we partner. It sounds like, I think what you described, Janine, is sort of maybe a little bit more one-off. Honestly, whether it's a CDFI, which would be preferred if you have something that's sort of specialized and aligned from a mission standpoint, but you can reach out to just any community bank, right? Some of the community banks that aren't CDFIs are still in support of those types of activities. So I'd encourage you, one, if you have some specific deal, let's, maybe talk after this, but more generally, if something comes down the road or you need lending, there's just, different banks in the area. And I'd way to take it even further, because a lot of times banks have sort of stricter rules in terms of, operating, how long you've been in operations for, whether you're profitable, that sort of thing. They're just, they have, what we call sort of a tighter credit box. But to the extent a bank doesn't work, there's about 1,100 non-bank CDFI loan funds that also could potentially facilitate a loan funding for you, depending on, who they are and what type of loans they play in.
So I'll kind of echo that, is that behind the scenes, I think a lot of people think banks are competing for deals. We're often referring between each other, saying, hey, can you peel off a piece here, participate here? We can't do this deal. This is, something that I think you would like. So definitely those behind the scenes, industry networks. Also, I was born in Indian country. I was born on a reservation. I've worked in it my entire professional life. A lot of people at the bank have as well. So, community connection and getting out there. I'm also on the board of the Denver Indian Center. So, really kind of being community oriented is how we find deals. The Moccasin Telegraph is fast. So, when there's new developments out there, it often lands at the bank, right? Kind of as a first brush. Is this something that Native American Bank could get involved with? And yeah, it's interesting. We need to do a better job marketing. A lot of people ask me, is that a real bank? So we absolutely, need to get out there and market our services and what we do, and get people outside of the community, right? Involved in our bank and our mission and what we provide to these communities. So.
Okay, I'm going to see if, yes, question in the back. Yeah.
And they're also positive ways of beneficial statements, so just to say all the interested parties there. But we work with a lot of families and foundations on how they can get their money working for justice and across different asset classes. And it's been interesting in what you were saying, Rob, people don't always prioritize cash and they want to do the sexier parts of impact investing. And I'm curious, how have you been able to get that to be more of a priority in the conversation? Because it's so opportune and effective and not risky. But getting people to really step up and do it is something we're all working on, but we'd love to be more effective at that.
I'm the chief lending officer, but about a month ago, I took over our Treasury management services department as well. So I want to know the answers to that question. How do we get more social depositors that are interested in putting their money with an MDI, right? How can we better tell our story, convey, hey, this money will land in 95% of our portfolio, loan portfolio, is with tribes, tribal nations, tribal entrepreneurs, right? It's going to land in Indian country and make an impact. How should I best tell that story, right? I think coming to events like this helps, but I will learn, right?
Yep. Well, all of the foundations or, those representing DAFs or impact investing operations, the thing that you need to know is you have cash that's sitting there in your account. And if you put it, sort of in a CDFI bank, and, sort of all these are FDIC insured, it can be 100% insured by the federal government. Mike.
Yeah, no, that's great. And So I'm not on the Treasury side, and I sit behind a desk and crunch numbers, and I get the sales team going out trying to source them. But same sort of community events. Again, we're a B Corp, so they participate in that. They're just active in the community for us. But when I think of a deposit, like, you're almost sort of, whether you're a consumer or a business, you know, you're almost stating your values with where you put your money, right? Because banks take that deposit and turn around and lend it. So if you think about the practices of banks that are doing good, you know where those funds are going to go. If you have banks that aren't necessarily doing the things that align with your values, it's going to go there if you give it to them. One of the things that's really cool for us is we have what we call our deposit calculator. So it's not as if you give us a deposit and we go take it and apply it to a specific project, but we can show you the pool of deposits that we have and then the loans that they're invested in. So you can get a general sense of the types of activities. Obviously, yours sounds great, 95% back to, you know, Native American enterprises. For us, it's a little bit more dispersed, but you can still get a sense. And I know our team uses that quite frequently, whether it's a consumer walking into the bank or in their RFP process for larger depositors. But you can really see that impact you make, and that's a key and critical thing for us.
Thank you, Morgan, for that question. Hi. I think one is the impact, which everybody is talking about, and I think the work of CDFI banks and credit unions is just, you know, unparalleled. I also think that there is lack of knowledge of some of the new systems that have come in. It's not that new. So, for example, you know, back in the day, we had started something called CDARS, you know, and not many people know that you can get insurance for up to $50 million or $100 million now.
No, well, the way that it works is any deposit you put in a FDIC-insured financial institution, this is true for credit unions as well, it's up to $250,000, but through a product called CDARS, and you may not know about it, but every bank in the country knows about this product. What you can do is, let's say you want to put $1 million in, let's just say, the way the CDARS network works, it's really an exchange of, I'll say, sort of charters amongst, you know, sort of thousands of banks across the country. So you could put a deposit in, let's just say, Native American Bank or Mike's Bank, and you put $1 million, they keep the $250, they send the remaining $750 out to 3 other banks, who then make reciprocal deposits back into their institution. So they get they get a whole $1 million that they can re-lend out.
Yep.
So, you know, if you think that, oh, it's just a small amount of money, $250,000, it really isn't, you know, sort of, because you can actually go much, much higher and get it fully insured.
Yeah, and, you know, and the idea is, you know, without getting to the nitty-gritty of CDARS, if you got $1 million in that example, if you got $10 million, if you have money coming in from different places, puts it in Native American Bank and Beneficial State Bank, you get 100% insurance from the government. That's just the fact. And I think there's an education aspect of this thing, there's a knowledge aspect of this thing. I think you guys are doing, you know.
Somebody asked me this question today.
So with that, and the third thing that we need to do is to get better systems where we can open online bank accounts. Again, many institutions are sort of investing in technology to be able to receive money online, click of a button, like ING Bearing, whatever it's called now, Capital One. You know, they started this whole thing about, you know, open an account with a click of sitting in the middle of the night. I want to transfer $250,000 into a bank. I can do it. These banks can do it today. So I think there's a little bit of education about what is possible, and then the infrastructure, you know, that is being put together.
All right, Jan.
Why did you ask by show of hands whether or how many in the audience are already banking with a CDFI?
Oh, awesome. Great question. With a show of hands, how many have worked with either, you know, financial services through a CDFI bank or credit union, or maybe a loan, you know, sort of through, let's see how many we have. Oh, wow. Okay. That's a good number. Good to hear it. Good to hear it. All right. Very good. So that's a great question, Jan. Thank you for answering it. or asking it. So anyways, do we have any last questions before we wrap up? All right, okay, that being the case, I want to thank Mike, Peyton, and Saurabh for sharing their wit and wisdom with all of us.